So welcome back to our next session, which is on mutual fund. So what we'll be talking about mutual fund? We are going to cover meaning and description of mutual fund, working of mutual fund, legal structure, regulation of mutual fund, SEBI and AMFI code, types of mutual fund products, process of investing in a mutual fund, what are the requirements, KYC and all other things, what are the different transaction plans, reading mutual fund information, what are the source, how to interpret all those informations, benefit and cost of investing in a mutual fund, alternative investment funds and ETFs, exchange traded funds, role and importance of a mutual fund distributor, understanding NAV, net asset value, TER, total expense ratio, M2M, mark to market concepts, non-financial transaction in a mutual fund, investor transaction, turnaround time, by what time they should be getting different, let's say statement of accounts or redemption request, all those things, risk involved in a mutual fund investment. So we are basically going to cover some of the things. So let's start with the meaning and description of mutual fund. So what is mutual fund? First of all, so when I want to invest, I have to invest in some investment product. Any investment product is made of some assets, and assets which you have already seen in our earlier session. It could be debt, it could be equity, it could be gold, it could be real estate. So there are different assets. But what happens if I have to invest? I'll be investing on my own, or maybe I'll be investing independently into a particular assets or in a particular investment product. Mutual fund is nothing but a trust that pools the saving of number of investors who share a common financial goal. So we have already talked about financial planning and all those things. Now anybody who wants to invest has got some objective, which we call it financial goal. It could be liquidity, it could be regular income, it could be return, high growth, it could be saving of capital, it could be tax saving, it could be anything. So basically what happens, there are different type of schemes, each having a defined investment objective, and people invest understanding that investment objective, matching their own requirement. So you have to match and invest in a right type of products. So there are different schemes with different objectives, and you have to invest in a right type of products. So there is a common financial goal which meets the investment through the investment objective as defined by the scheme. So money collected in a particular scheme is invested in a portfolio of securities, be it debt, equity. And in which type of security the money has to be invested? It will be invested in those type of securities which is going to help to meet the investment objective, which is defined, and also meet the investment objective of the investor. So money will be invested in a right type of assets. For example, let's say if somebody is looking at liquidity, of course money cannot be invested in long-term asset or growth asset, which is equity. If somebody is looking at growth, then of course money cannot be invested in a short-term debt. So it is defined, well defined. And as we go ahead, we will be talking in detail about it. Now, anybody who is investing, of course, looking at a return. Now, from where the return will come? So there are two sources, which we already talked earlier. One is regular income, which comes either in form of interest income or dividend, or there could be capital appreciation. So these two combines gives the return to the investor. Now, somebody can have invested, let's say 10,000, somebody might have invested 10 lakhs, somebody might have invested 10 crores. So different amount has been invested. So based on that, people are going to get the units. So that means it's a proportionate investment or proportionate holding based on how much investment you have done and how much units you hold. So investor contribution in a mutual fund is denoted in terms of units. So unit is nothing but a price. It's a how much you are holding. Unit holder participates in the benefit from the mutual fund in proportion to the number of units. So let's say if any dividend is given, so based on how much units you hold, accordingly you will get the dividend amount. Mutual fund is just a pass-through intermediary. When I'm saying pass-through intermediary, it means the investment is done on behalf of the investor. The asset management company or the mutual fund just invest on their behalf as per defined investment objective under the SEBI regulation. So all the income, all the profit belongs to the investor. Or if there is some loss, that also goes to the investor. So mutual fund is just a pass-through intermediary. When I'm saying pass-through intermediary, it means mutual fund does not pay any tax, because ultimately the real beneficiary is the investor who has invested. So the taxation also is passed on to the investor. So it's just a pass-through intermediary investing on behalf of investors, and whatever benefit which is coming, that is passed on to the investor. So this is a mutual fund. Now, why mutual fund is required? Somebody can invest directly in asset or investment product, but as I told you, investors have got different preferences, and mutual fund launches different type of schemes in order to meet any of the preferences of the investor. So let's say somebody is looking at easy liquidity, somebody is looking at a regular income, somebody is looking at the growth of the money. So you have got a defined scheme with a defined objective, and an investor is supposed to understand all these things. That means he should know what is the objective of the scheme, what is his own objective for what he is investing, and then based on that he should match. That means he should be buying the right type of product, which we say he should look at which product is suitable to him and invest accordingly. What is the role of a mutual fund? So it assists investors in earning income or building wealth by participating in the opportunities available in the various securities and market. So we are a developing economy, we are a growing economy, so many opportunities are coming. So it helps an investor to gain on those opportunities. So it's those opportunities or the gain avenues are provided through mutual fund. Money mobilized is invested in different securities. Let's say Government of India securities, GSEC, or corporate bonds, or shares floated by some company. So money is invested there. Those monies of course are raised to help some of the other projects. So it is helping in the economic development of the country. Mutual fund being one of the largest institutional investors along with the insurance company, they keep a track on the investing companies, wherever they have invested, their corporate governance, their ethical practices. And if something goes wrong, they'd highlight this thing to the management in the various meetings. So what happens if, since they are keeping a track on the investing companies where they are investing, it also helps the other investors, particularly retail investors, to understand if mutual fund have taken any stance or they convey something. So that helps the retail investors and also puts some break or some, I would say, audit type of thing is done on those companies. The investing companies provide employment. Naturally, let's say if the money has invested in Maruti shares, Maruti company, or let's say Hindustan Lever, then of course those companies are growing. They also provide employment to a lot of people and helping in the economic development of the company. So it's helping them. Mutual fund being an industry provides livelihood to a lot of people. So there are many people who are associated with mutual fund. The AMC employees, the distributors, even some of the service providers whom we are going to talk later on. So it helps them also. Mutual fund also acts like a market stabilizer to counter large inflow and outflow. Now we have seen there was a time when our stock market was dominated by FIs, inflows and outflows. And they are the most dominant part as far as judging the direction of the capital market was concerned. But now we have seen mutual fund is an insurance company in particular. They are playing a very, very active role in that. And many a times we know in a mutual fund, basically it's the domestic investors, be it retail or be it institution, their money is getting into it. But the foreign money which is coming through FPI or FIs, they are not Indian investors. So they can come looking at their own interest. So let's say, for example, if they find Indian market is not so attractive, maybe Singapore is more attractive than Indian market, they might withdraw their money and move the money to Singapore. And that can harm the local or the domestic investors. So in that case, what happens? Mutual fund acts like a market stabilizer. So maybe mutual fund will come and invest and it will ensure that market does not fall very drastically. So mutual fund acts like a market stabilizer. So these are the roles of the mutual fund.